Hi everyone, welcome to the next episode of the Accounting and Tax Help Desk podcast. Nima, I'm here to talk about what we need to do after the tax season, how we can use our tax return as a tool to plan the future. So, your tax returns can show you a lot of information about your lifestyle or life, but not to the extent that your credit card or other things shows, but it shows give you some perspective. First thing you know how much you actually made, because sometimes you don't see the actual cash if you put your money in the investment. If you invest in some other places, but in your tax return, it shows how much your investment make money. So you see the better picture of your actual income, how things going. If you're having a business tax return, it shows how much assets you have, how much liabilities you have, how much you're making money, and how much you take the money out from your company. So it gives you a lot of information. So you need to take a look at your tax return and see first what you need to do to save taxes for the future. What opportunities you have, like do you need to contribute to your retirement accounts or something like this. So tax return is a powerful tool for you to set a goal and then know where you are and then plan for the future financial success. So the tax return is a powerful tool mostly for the income perspective. For the deduction, I would say it doesn't give you that much information about your spending power because none of your personal expenses is going to be included in your tax return. But from the income perspective, it can tell you how much you made, or for a tax perspective, for deduction perspective, you can see how much what expenses you can deduct from your taxable income. Like for example, if you pay mortgage and some people tell you, oh, your mortgage is deductible, just the interest portion of it is deductible. So if you pay $4,000 a month for a mortgage, doesn't mean at the end of the year you deduct 48,000 from your taxable income. So the tax return give you some of those information, like what kind of deduction you can take, what kind of income is going to be included in your tax return. If you have a rental properties, you see the income and expenses is different than your actual cash flows because depreciation is involved. So a lot of other information tax return gives you that is different than your cash flow, that is very helpful to see the better picture of your financial situation. So when you look at the return, you may see, oh, you forgot to report some of your income. Some of your income would be income from a side gig. You work for somebody, you got cash, and I say, oh, that's it. I have cash. I don't need to report it. Later on, you will receive a 1099 that you earned 10,000. That 10,000 is gonna go to IRS records, and they know you made 10,000. So you're better to report it, and then actually it's better to report it and then deduct your expenses against those income. So because if you don't report it and you get the IRS notice, the IRS shows you have an income 10,000. So you have to pay taxes plus interest and penalties on that 10,000. But if you report it and then deduct expenses against it, you're in a better situation. So unreported income is the first thing. Investment income is the other thing. You receive a 1099, you receive a K1 you forgot to report. It's all about investment. You invest somewhere, you don't see the cash, but those investments making money, they reinvest themselves. Your investment is growing from the IRS standpoint or from any financial perspective. You're making money. In order to grow your investment, you need a working capital. You need to make money to order to or get money from somebody. But in this case, you're making money. So that's why your investment is growing. You don't see the cash, but investment is growing. But at the same time, you have to pay tax on your income. So forgetting to report your 1099s and K1s is the other areas that people forget. Again, your financial planner invest your money, sell some capitals in a good deal. You get a lot of gains. Some clients don't even know about it, but about like they have 100,000 capital gain, uh, and then they have to pay taxes on it. So forgetting to report income is the first thing people miss. Deduction and credits, sometimes you don't know about it. For example, you didn't communicate things correctly with your CPAs, or CPAs wasn't aware of it. For example, you're complaining about wife or husband and say, we're getting divorced. CPA sometimes think, oh, your divorce is done, so file your return as a single. And then later say, okay, we're getting divorced, we talk about it, but we didn't get actual divorce. So make sure you communicate everything correctly. Make sure you review your tax return. If you have a child, if you take your child to the childcare, daycare, make sure communicate all of those, because all of those opportunities for deduction and credits. If you're contributing to your HSA account, it's if you contribute to your IRA, traditional IRA, so all of these needs to be communicated to your CPAs, because you don't want your CPA miss your deduction opportunities. So if you don't receive a 1099, and it might happen, first your employer or the person you work with forgot to issue a 1099, or they were not aware of it, that they need to issue a 1099, or they didn't have a good accountant. Anyway, so you work for somebody and then you forgot, and you haven't received a 1099. Legally, you still need to report that income. Legally, you need to communicate with your person that you work for, your clients, your employer. You need to ask them to issue a 1099. So it doesn't mean if they didn't issue a 1099, you don't need to report that income. But again, if you report that income yourself, you have opportunities to deduct your expenses for that income. So don't forget to follow up to get your 1099s. First, you want to make sure they report the correct 1099s. If you receive 5,000, you don't want to see a 1099 for 10,000. If you get reimbursed for some expenses, make sure it's not part of the. For reimbursement expenses is a gray area. So if you reimbursement expenses included in your 1099, you can deduct those expenses. So make sure all of this communicated with regarding your 1099s. To reducing your next year taxes, you done with this year tax and say, oh, I pay a lot of taxes. You need to see what your situation is. Are you self-employed or are you employees? If you're employees, then you need to see if you do the itemized deduction or are you doing standard deduction. Are you filing the correct status? Maybe you have a dependent. Maybe you have options to file as a head of household. So it depends on the situation. Let's start with the situation your employees, and you just do the standard deduction. But at the same time, you have a dependent, and you're single. You have a dependent, but you have been filing as a single. If you consult with your CPA, they can change that to a head of household. It's going to be a big tax saving. First, it's going to change your standard deduction. Second, you get the tax credit. And third, you're going to be in a different bracket. So even your employees, you do the standard deduction. Sometimes there is a way to save taxes. In other scenarios, you are employees, W2, and you do itemized deduction. And you see that you have options to do some more charitable contributions. So deduct your taxes. Just remember about the charitable donations. If you donated like $1,000, doesn't mean your tax is going to be lower than $1,000. It's not going to be dollar by dollar. It's just reduce your taxable income, and based on your tax bracket, you pay less taxes. Same with the retirement account. Doesn't mean if you put some money in the IRA account, you pay less, 6,000 less. No, it's bring down your taxable income down, but on the basis on bracket, you pay less. But at the same time, if you think about it, okay, you put your money for the better things instead of paying to the government. Paying to the government is not bad either, but just saying, okay, you can do for the better options for the charitable contribution. And then for your retirement, you put aside more money for yourself, you pay less to the government. And the cash flow wise, you maybe pay more because first you need to put aside 6,000, 7,000 for traditional IRA and then pay about 20% less to the taxes. The cash flow may be not in your favor, but if you think about it, that 6,000 basically is put aside for you, for your future. Um, so the third option, you're self-employed. When you're self-employed, you have a lot of options for tax saving. First, you need to look at your business strategies, like business structure, LLC, C corp, S corp, uh, and then if make sure you take all of the deduction that you can, and that's happens with the proper communication and working with the CPA, and make sure you use all the deductions and opportunities to deduct your taxable income. So as you see, there are a lot of options, different scenarios. You can reduce your taxable income for the next year. A lot of things you don't know. You need to consult with your CPAs. And from that point, you can plan better for the next year. And always remember, you shouldn't be surprised by April 15. You should always know kind of, okay, how much you owe on April 15. Not exact amount, but uh, you need to know, okay, maybe I owe 5,000 or 6,000. But if you're in a point that you're, oh, I may owe 5,000 or 40,000, so that's not a good situation. To set tax return, you see a taxable income, you forgot to track your deduction correctly, and then comes to the taxes, and they tell you, oh, you paid this amount of tax. Say, oh, I don't receive that much money. I don't have that much money. And means, okay, so there were some deductions that you forgot to include in your tax return. Means if that was the case, that you think you didn't make that much money and you pay that much tax. So it means you didn't have, if you're self-employed, you have a business, you didn't keep track of your expenses correctly, you don't have a bookkeeping in place, and you forgot to include all of the expenses. If you have a business entities like LLCs, C Corp, S Corp, you're just not tracking expenses, you need to have a proper bookkeeping. Everything needs to be balanced. Your cash needs to be reconciled, your liabilities needs to be reconciled. So you need to have a proper bookkeeping. If you have a proper bookkeeping, no expenses is going to be missed. The only time it might be missed, there are some personal expenses misclassified as a business expense or vice versa. If you're self-employed, you don't have a business structure, you don't need to have a financial statements, but you need to have a good track of your deductions. It shouldn't be just by guess, it shouldn't be an estimate. You just need to look at your bank statement, look at your transactions, and make sure you consider all of those expenses you paid. If you don't track your expenses, there is no way to make sure you claim all of your expenses. Just don't send your credit cards to the CPA in April 14th, all of your credit cards, and then all personal credit cards, and expect your CPA deduct your expenses correctly. First, they don't look at your credit cards, especially personal credit card, and don't expect to deduct all of those expenses. So if you don't use a bookkeeper or a CPA and you track your expenses yourself, make sure you track your expenses correctly. You can use different apps. You can just use the Excel sheets and just each month look at your bank statements and include all of those expenses. You can use the Quicken if your business is not that big. Just there are a lot of ways that you can keep track of expenses and make sure you keep track them correctly. So the tax return definitely can tell you when you need to hire somebody. And it's professional CPAs or bookkeeper. It's especially when you have a business. When you have a business, most likely you need help. You cannot do the bookkeeping correctly unless you really know accounting. If you really don't know accounting, you have to ask CPA or a bookkeeper or professional help you with the bookkeeping. When your business growing, your transactions a lot, you have a payroll, you need to reconcile all of those expenses. You pay credit card for your business, because a lot of times I see that people think when they pay a loan or a credit card is expense. It's not. When you put the money in the credit card, it's expense. When you pay the credit card or loan, it's reduction of the liabilities. If you're not an accountant, you might not know. You expect to see two deductions. One, the expense happened by credit card when you pay the credit card. So all of these small things, if you're not an accountant, you may mistake. You may double your income. I see a lot of times that the clients do their own bookkeeping, and first they record the income when they invoice the clients, and then the second, when they receive the payment, they record the income again. So it's double counting the income. So in these cases, you will see if you're not an accountant, if you don't know the bookkeeping, you may make a lot of mistakes, and then your numbers is not the amount that actual numbers. So again, so you don't want to be surprised by end of the year. Your situation changes every year. Sometimes there are a lot of scenarios I can tell you that surprise clients. If you're employees, something changes, you need to communicate with your CPAs. You need to check if your employees, they will look at your pay stub, they look at your situation and plan it. There are a lot of times that husband and wife works as employees, and based on W-4, they have different withholdings because W-4 doesn't know anything about you. The payroll company doesn't know anything about you. For example, you work like you make $100,000 as a salaries, and based on that, you have W-4, you put some of your information, you're married, one kid, and then your withholding is going to be 10%. Your husband or wife, the same situation. They have like 100,000 there based on W-4. The payroll company automatically, based on that W-4, they deducted 10%. So if you see in these scenarios, two people, husband and wife, their withholding during the year is 10%. But when they combine their income together and they file the tax return, their tax bracket is 20%. So you're short about 10% on each withholding. So you're going to owe a lot of taxes during the year. So in these cases, you need to communicate with your CPAs. For example, if you have a new source of income, another member of family started a new job, you need to communicate, say, these are my pay stub, please do a projection to see how much we owe, do we need to change our withholdings? If you're a self-employment, it's a different story. If you're making, because if your CPAs don't do your bookkeeping, they don't know how much you make, they need to do projection and see how you are doing this year, and then do a projection and you pay taxes based on the current year. So there is only way you don't need the mid-year projection is your W-2 employees, nothing changes, everything is in line with the last year, and then last year you didn't overpaid or underpaid, you can leave it the way it is. But if anything happens, if you get a bonus, if you get stock options, if a member of family got a new job, if your status has changed, divorced, or the other vice versa, you get married, you have children, you need to communicate during the year to avoid any surprises by April 15th. So one small change is just improve your bookkeeping, financial, if you're self-employed. If you have a proper bookkeeping and your CPAs aware of your books during the year, you are in the best situation. They know where you are, they can project your income, they can project your tax liabilities, and you will not be surprised. Just with to have a proper bookkeeping as a self-employed, you will be in charge of your taxes during the year. And thank you so much for listening to this episode. We went over the different scenarios that what you can do to improve your taxes for next year, pay less taxes, and optimize your taxes. If you have any questions, please email us at helpdesk@alamircpas.com. Please like and subscribe us and send a message in our social media platforms if you have any questions.